In 2025, the United States escalated a bruising trade war with China, slopping tariffs as high as 145% on Chinese goods. The move immediately fractured global supply chains. This chart shows global GDP growth projections from the World Bank. As those tariffs took hold, you can see the global growth rate flatlining at just 2.5%, the weakest economic expansion since the global pandemic. The two largest economies on Earth halted their own expansion to fight a tariff war. This created a massive economic vacuum, threatening to drag the rest of the global market down with it. Entering this period of global instability, India already possessed significant momentum. Between 2015 and 2025, the country successfully doubled its gross domestic product from $2.1 trillion to over $4.2 trillion. Looking back at our economic chart, while the rest of the world stagnates, India tracks a robust 6.5% growth rate. When the 2025 trade war finally broke, India leveraged the supply chain vacuum to its advantage. By positioning itself as the primary alternative to China, New Delhi converted global economic friction into a $1 trillion domestic stimulus. In February 2026, the U.S. and India struck a sweeping bilateral trade deal. Washington slashed tariffs on Indian imports down to 18%, while maintaining the massive trade wall against Beijing. Facing those steep penalties in China, multinational corporations panicked. They urgently executed a strategy known as China Plus One, scrambling to find manufacturing hubs outside of Chinese borders. India absorbed that manufacturing overflow. As American companies dropped their Chinese suppliers, Indian factories stepped in to secure a $15 billion surge in smartphone exports to the U.S. The tariffs forced production lines to pack up and physically relocate out of Shenzhen, settling directly into the Indian subcontinent. Building smartphones, electrifying railways, and pushing electric vehicle adoption requires physical materials. That industrial demand triggered a commodities supercycle inside India. Take copper. India needs thousands of metric tons of it for data centers and power cables, but the country suffers from a structural deficit. It lacks the domestic ore required to meet this demand. To keep the factories running, India pivoted to a circular economy. They are now importing and processing massive volumes of global copper scrap, smelting it down to feed their industrial machine. A similar pressure hit silver, a critical component for both electronics and renewable energy hardware. That industrial demand helped push silver to a 22.1% return, topping a decade-long performance chart across all asset classes. India is actively rewiring global commodity supply chains, turning other nations' recycled scrap metal into a strategic national asset. This rapid physical expansion created a financial vulnerability. As Indian companies grew, their valuations spiked. Foreign investors started cashing out, repatriating their profits back home, which placed downward pressure on the Indian rupee. To protect the currency, the Reserve Bank of India deployed a $40 billion maneuver, fully subsidizing foreign exchange hedging. By removing currency risk, the central bank incentivized lenders to raise 3 to 5 year foreign deposits, pulling US dollars back into the Indian banking system. At the street level, everyday citizens are also actively funding the boom. Retail investors are pulling money out of traditional savings and pouring it into a corporate bond market, chasing yields between 7 and 14%. Simultaneously, the population is hoarding physical gold, using the precious metal as a localized buffer against global inflation spikes. Central bankers stabilized the currency from the top down, while retail citizens injected capital from the bottom up. Together, they built a financial fortress to keep their $4.2 trillion engine from overheating. In just a few years, India shifted its identity from an IT outsourcing hub into a viable global manufacturing alternative. Global commerce rerouted, bypassing Chinese ports in favor of New Delhi and Mumbai. There are domestic trade-offs. To secure that lucrative U.S. trade deal, India promised to pivot away from cheap Russian crude and buy American oil. That shift threatens to hike everyday fuel and gas prices for Indian consumers. In an era defined by fractured trade and massive tariffs, economic survival requires flexibility. The ultimate winners are nations with adaptable economic shock absorbers.